Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. I'm Krish, and remember, living rich isn't about being lavish, it's about living peacefully. Now, before we get into it, just a quick reminder, please always consult a SEBI-registered financial advisor to make a plan that's personalized just for you. Okay, let's get started. You know the feeling, right? The market is soaring, everyone's talking about their profits, and that FOMO, that fear of missing out, it is so powerful. You feel like you just have to get in. But then the market takes a nosedive. It drops 20, maybe 30%, and just like that, all that greed flips into pure gut-wrenching fear. The news is screaming crash, and every single instinct in your body is telling you to sell. Sell now before it goes to zero. Well, that emotional roller coaster, it's the number one reason people lose money. They buy high and they sell low, the exact opposite of the plan. And this quote just hits the nail on the head. You see, the market itself isn't the enemy. Our own emotions are. Winning in investing isn't about being a genius who can predict the future. Nope, it's about having a system that protects you from your own emotional reactions when things get scary. So, what if there was an investment that did the hard work for you? Something that automatically forced you to buy low and sell high without you having to make a single stressful decision? Well, that's what we're talking about today. It's like an automatic car for your financial journey. It's called a hybrid fund. So, what exactly is a hybrid fund? Well, in simple terms, it's a mutual fund that invests your money in a mix of things. Primarily, it's a blend of equity, stocks, which are like the engine for growth, and debt, things like bonds, which act as the brakes, giving you stability when the road gets bumpy. By putting them both together in one fund, the whole idea is to give you a much, much smoother ride. And that's why autopilot is the perfect way to describe it. Think about it. The fund manager is constantly watching things. When stocks start to get really expensive, the fund automatically sells some of them and parks the money in the safety of debt. And when the market crashes and stocks are on sale, it does the exact opposite. It takes that money from this safe debt portion and goes shopping for bargains. It does all this rebalancing for you, taking your emotions completely out of the picture. To really get this, let's use an analogy. Let's say your financial journey is a long road trip. The kind of vehicle you pick is going to completely change your experience. The speed, the safety, and just how comfortable you are along the way. So take a look at this. You could choose the bike. That's like picking individual stocks. It's fast, it's exciting for sure, but one wrong move, one pothole in the road, and the whole journey could be over. Or you could take the bus. That's kind of like a normal diversified mutual fund. It's steady, it's safe, but man, it can feel really slow sometimes. But the hybrid fund? That's your hybrid car. It's got the power you need when the road is clear, but it also has all the safety features you want for when the weather gets bad. It's built for an all-weather journey. But hey, just like with cars, not all hybrid funds are created equal. You've got different models for different drivers and different destinations. And this is really important. You have to match the right fund to your financial goals and, just as importantly, to your own personality. So let's pop the hood and take a closer look. Broadly speaking, here in India, hybrid funds come in three main flavors. You've got your aggressive hybrids. Think of these as growth with a built-in cushion. Then you have balanced advantage funds, or BAFs. These are the really smart all-rounder type. And finally, conservative hybrids, which I like to call the FD+. Let's break down each one. All right, first up, the aggressive hybrid. This one is for someone who really wants to build wealth over the long haul. We're talking goals that are at least 5 years out. But maybe you're a little spooked by the idea of a 100% equity fund. This is the perfect middle ground. It's got about 65 to 80% in stocks, so it has a powerful engine for growth. But that other 20 to 35% in debt, that's your shock absorber. It just makes the ride less bumpy. And here's the best part. Because it has over 65% in equity, it gets taxed like an equity fund. That means lower taxes on your long-term gains, which is a massive, massive advantage over time. Next up is the Balanced Advantage Fund, the BAF. Now, this is the really smart one. It's dynamic, which means the fund manager can change the mix in a big way. The equity exposure can swing all the way from just 30% up to 80%, and it does this automatically based on market valuation models. So when the market looks expensive, it pulls back on stocks to protect your money, and when the market looks cheap, it loads up on stocks to capture the upside. This makes it an absolutely fantastic choice for retirees or anyone with a medium-term goal, say 3 to 5 years, because its main job is to protect you from big losses. And finally, we have the conservative hybrid fund. This is for the person who puts safety above everything else. You know, someone whose money is normally sitting in a fixed deposit, but they're hoping for just a little bit more. With up to 90% of your money in safe debt, it's all about capital protection. But that little 10 to 25% in stocks is there to give it a small performance boost. That's why I call it FD+. Safety first with just a little kick of growth. And don't dismiss that little plus. It's more powerful than you think. One of our sources shows that over a 20-year stretch, these super safe funds have actually delivered returns in the range of 13 to 14%. Now, that is way better than your average FD, and it just shows you the incredible power of adding even a tiny bit of equity to your portfolio over the long term. Okay, enough with the theory. Let's make this real. Let's look at how this all plays out in a real-life market crash. We'll follow two different investors and see how their choices lead to two totally different outcomes. So in scenario A, we have the panic seller. He puts all his money in a pure equity fund, the market tanks 30%, and boom, his portfolio is down 30% too. He can't handle it, he's not sleeping, he panics and sells everything, turning a paper loss into a real permanent loss. That's wealth destruction. Now look at scenario B, the hybrid investor. She chooses an aggressive hybrid fund. When the same 30% crash happens, her portfolio is only down about 15%. Why? Because of that debt cushion. The fall is just less scary. So she stays calm and stays invested. And you know what else is happening? Her fund manager is now taking money from that stable debt part and buying more stocks while they're cheap. So she gets peace of mind and her fund is set up perfectly to grow when the market turns around. That's the difference. Okay, so this all sounds good, but how do you actually do it? How do you pick the right fund for you? Well, here's a simple 4-step checklist to guide you. Step 1, you have to be honest with yourself. I call this the sleep test. If the idea of your portfolio falling 20% would keep you up at night, then pure equity is probably not for you. A hybrid fund is a much better choice. Step 2, match the fund type to your goal's timeline. If your goal is 3 to 5 years away, a balanced advantage fund could be perfect. If it's more than 5 years away, then an aggressive hybrid makes sense. Step 3, check the fees, or the expense ratio. These funds are actively managed, so there's a cost. Just make sure it's reasonable. For a direct plan, try to find something under 1%. And finally, step 4, think about taxes. For those long-term goals, an aggressive hybrid or a BAF is a great option because you get the safety of debt with the tax benefits of equity. Okay, let's wrap this all up. Let's quickly recap the most important points about why hybrid funds can be such a game changer for so many investors. At the end of the day, it all comes down to this. Hybrid funds manage your behavior. By making the journey smoother, they stop you from panicking. They automatically do the one thing we all find so hard. They buy low and sell high for you. They can be incredibly tax efficient, and for a lot of people, they're the perfect one-stop solution. The kind of investment you can just fill it, shut it, and forget it. And because the ride is less volatile, you're more likely to stay invested for the long run, and that is where the real magic of compounding happens. So I'll leave you with this one question to think about. What do you really want? Are you chasing the absolute highest possible return, along with all the stress and sleepless nights that come with it? Or do you want the best sleep of your life, knowing your money is growing for you steadily and safely? Hybrid funds give you good returns with great sleep. Choose wisely. Thanks for joining me. Be sure to subscribe and check out the links in the description. Live rich and leave rich.